Now, you're probably wondering why What's up everyone, Dane the Mortgage Guy here with your 3-minute Thursday video of the week. Now last week I talked to you guys about debt to income ratio and how to calculate it and why it mattered, and I gave you guys a couple rule of thumbs to keep in mind when calculating your debt to income ratio. And today I want to talk to you guys about loan to value. Now, you know the drill: clock, info, disclosures, amazing mortgage company that I work for, which you should get your mortgage through. And 3-minute Thursday starts now. Loan to value. What does that mean exactly? Well, if you take the amount of your loan, whether you've had it for 1 month or 10 years, and you divide that by how much your house is worth, that's going to give you a percentage, and that's going to determine what your loan to value is. Now, why does loan to value even matter? Well, let's take a look at it from a non-lender point of view. If you think about it, loan to value is essentially how much skin you have in the game. Now, I'm sure you've heard that term before. Now, along with multiple other variables, LTV plays a part in determining what your risk assessment is on your loan. If you have a high loan to value and you have a high debt to income ratio, you're going to be considered a little bit higher risk than somebody who has a low debt to income ratio versus somebody with a low DTI and a low LTV. They're going to be considered less of a risk factor. Now, depending on which lender you go with or what program you're on, obviously there are tons of variables that go into this, but if you are over 80% loan to value, then you're most likely going to have to pay a mortgage insurance premium, also known as MIP, or some of you may have heard it as PMI. Now, you're probably wondering, why do I have to pay an insurance premium when I'm at 80%? Well, you're gonna pay a much lower insurance premium if you're at 81% versus if you're at 96%. But I'm gonna explain more of that later on in this video because I only have 3 minutes and the clock is ticking. Now, sometimes you'll hear the term CLTV, which is also known as combined loan to value, and that's typically only going to happen if you have a first and a second mortgage on your house, which does happen every now and then. Boom! Did it under 3 minutes, just like I knew I would. I'm getting way better at doing these things under 3 minutes. Now, like I said earlier, if you have an LTV higher than 80%, you're most likely going to have to pay a mortgage insurance premium of some sort. Now, let me explain why you need to do that. Let's take, for example, you buy a $300,000 house, right? You put 10% down, you make a few payments over it, and at some point you now owe $250,000 on your house that is worth $300,000. That puts you at an 83% loan to value. Now, let's say you decide to quit paying your mortgage for whatever reason, which I don't recommend doing. Please pay your mortgage. And while you're not paying your mortgage, you decide that, well, I'm already going into foreclosure, so I'm just gonna trash this house and make it unlivable. Okay, well, it's your house, you do as you please, but eventually it's gonna end up with the bank. Now, the bank finally ends up foreclosing on you. They come by, they say, bye Felicia, you move out, but you've got a $250,000 debt that you have to pay the bank back. Well, they can either, one, try and sell the house and make that $250,000 back, or most likely they're gonna have some sort of insurance policy to protect them in these types of situations. So not every loan program is going to have the same guidelines. There's no like general rule of loan to value calculations for every single loan. Each loan to value is going to be determined by the program itself. Now, if you are looking to refinance, these are a few tips that you're going to want to keep in mind when thinking about the refinancing process. If you decide to go cash out on a refinance, you can go up to 80% loan to value of your home. Now, if you go up to 75% loan to value, typically, not always, but typically you're gonna get a better interest rate at 75% and under than you are at 80%. Now, if you're doing a rate term refi, or also known as a no cash out refi, you can go up to and sometimes over 100% loan to value. Now, like I said earlier, that is dependent on the program that you are and the program that you qualify for. There are far too many variables to actually tell you what that number is, and I don't want to give you bad information because then that puts my license on the line, and I ain't trying to get myself fired or banned from being able to do this because I really like my job. So there you have it, loan to value explained, and I did it under 3 minutes originally, and then I kind of like rambled on, and I don't even know how long this video is at this point. As always, thank you so much for watching this video and hanging out with me and allowing me to explain what this loan to value thing is all about to you in hopefully under 3 minutes. You can totally cut the video here because the rest of this video is exactly the same as all my other videos. Make sure to follow me online on Facebook, YouTube, and Instagram at Dane.the.mortgage.guy, and also check me out on my website at DaneTheMortgageGuy.com, or the shortened version, DTMG. Once again, thank you all. I love you all. I hope you are staying safe and staying sane during this quarantine, and hopefully life gets back to normal within the next few months or so. Cheers, everyone. See you guys next week.